Muted.
financing specifically where it relates to young people, and there's not a big difference between whether you're 35 or 75, but there are some variations that are worth discussing with you all tonight. Just for your interest, Robinson Sewell Partners do specialise in agricultural finance, and we've settled over about $337 million worth of solutions for farmers over the last 4 years. So I've just spent the last week as far north as Zaramak and out to Quilpie and in the Cunnamulla area tonight. So if we go to the second slide, which is where to start as a young person in the industry, one of the most important things you need to do, which is the first point, is broadcast your ambitions on a personal scale within your community and amongst family, friends and colleagues. And fundamentally that's all about networking. I was with a young couple of Blackall this morning who have cattle on agistment, cattle in a feedlot. They've got a house in town, and they're out looking for property to buy. And it's important when you're at any stage of life really that you let people within your network know what your ambitions are. If you do nothing other than just communicate amongst your friends, and the broader rural community doesn't know what your ambitions are, then they're not going to present opportunities to you. I deal with a lot of young people in agriculture. Probably 40% of the transactions we have at the moment, which are around $50 to $60 million, are with young people, and fundamentally those opportunities arise when people in areas that you're trying to get into are aware of what your ambitions are. If you already own land, then it's quite obvious, but if you don't, then people don't know whether you want to be in agriculture or not. And you need to sell your story. You need to express to a certain extent the passion you have for the industry, because the older generations are very receptive to young people wanting to come into the industry, but if they don't understand that that's what you want to do, then they're not going to put opportunities in front of you. I have a couple at the moment who a vendor specifically would like to buy their property and they're unable to do that at the moment, and the vendor's giving them an 8-month deferred settlement time to get a few of their financial affairs in order so that they can secure that purchase. So it's very important that you let people know. At the races, at the pub, just don't sit there in the corner with your mates. If you see one of your local graziers, interact and let them know what you're trying to achieve in life. You'd be amazed at the opportunities that will present to you on that basis. I have young people all through the Northern Territory, Queensland, New South Wales, and in South Australia who are getting some opportunities because they're letting it known that their ambition is to get into agriculture. It's also important to keep yourself educated. Education is a form of networking, be it going to one-day courses put on by the likes of DPI, or whether it's a grazing for profit or it's an ag force event. You need to ensure that you're educating yourself and keeping up with all the latest in everything from finance to management to practicalities. Banks in particular take note of your interest in agriculture relative to how involved you are in educating yourself. Some banks, up to 30% of the credit assessment includes what they perceive to be your management skills. So you actually get a score which you'll never hear about or know. Most people believe that it all comes down to security and cash flow, but management is key in lending. Investigate all opportunities, which I'll go on to shortly. and be transparent. You know, be upfront and honest with people when you're talking to them about what opportunities might arise. So we'll go on to the next slide. Can we go on to the next slide?
You did.
Yeah, we're on the next slide. Thanks, Brad.
Alrighty, yep. So just bear with me, I'll turn the page. Okay. So these are some of the options that you need to look at when you're in how to get into agriculture, and they're all pretty obvious: adjustment, leasing, share farming, land purchase, succession planning, joint venture, partnership, equity partners. Now, quite a lot of young people I deal with build their equity as a launch pad for getting into property ownership via lower capital cost opportunities such as adjustment, leasing and share farming. And the couple I saw this morning have cattle on adjustment. They're building their cattle numbers so that at a certain point their plan is to split the cattle into a portion that can be sold to help with the deposit on a property, and the breeder portion would be retained to stock a property. So opportunities such as adjustment, leasing, everybody's looking for leasing at the moment, even you know, all age groups, because it is a low cost. So I quite often run into young people who are putting all their eggs in the leasing basket and waiting for that opportunity. The reality again is that most leasing opportunities arise through networking. So if you look at most opportunities that arise in leasing and share farming, it's because of the people you know. Not many get advertised, unless it's something like Napa Merry out in the Channel Country, or some of those bigger property opportunities. So again, networking's key. You've got land purchase. Now, one of the big issues for young people in agriculture at the moment is having a big enough deposit. So as we all know, banks will lend around, you know, between 60 to maybe 70% of valuation at a stretch. So where do you find the other 30 or 40%? Well, quite often it's around vendor finance. It's around sitting down with the vendor and discussing with them the opportunity to pay them, say, 50 or 60% cash up front, and then defer the balance over a number of years. Now, traditionally that hasn't been popular with vendors because with capital gains tax exemption, they have preferred to get their cash up front and move on to the next phase of life. But as we drift further away from the capital gains tax threshold in 88, 89, there's more and more properties coming up where those exemptions aren't there. So vendors are more and more starting to look at, you know, some cash up front and then the balance over a number of years, so that the tax implications aren't so great. The other compelling reason for vendor finance at the moment is that term deposit rates are around 2%. So if you give them all their money and say they want to retire to Toowoomba, they buy a house, say they buy a property for $1.5–2 million. They probably need 500 grand or 600 grand for a decent house in Toowoomba plus some living. So they actually don't, to a large extent, need all the money up front. And so if they get a significant amount of cash, and at the moment they're getting 2%, you know, that's not as great as a purchaser offering vendor finance of around 5%, so they can get a greater return on the balance. They secure their position with a second mortgage behind a bank, so it's not as if the vendor's out on a limb with respect to the risk they've got in doing that with you. And as some of you would have seen on the news tonight, with the way the share market's going, maybe that's not a compelling place to be at the moment with surplus cash. So vendor finance is quite a strong potential opportunity in your acquisition. I quite often meet older clients in my position that would seriously consider a vendor finance opportunity if it came along, and particularly with younger people. I mean, I'm yet to see the older generation not want to support younger people. The first thing is, as I said at the start, they need to know that you want to be in the industry, and secondly, they need, position put in front of them. The other aspect to it is family support. Having your parents, for instance, putting their property up as collateral. They might simply go guarantor for you, or in some cases we get the parents to borrow the money because they actually have the credit rating, and therefore we get a separate loan in their name against their property. It's just that you would pay them the interest and the principal over time. And it's probably preferable, best case, that we just simply get the parents to guarantee the debt if they do have available security or cash or whatever it might be. Succession planning. That is a way of getting into agriculture, and I have to say I ran a workshop in New South Wales a week ago, and we had 40 young people come in from all over the state, and the overwhelming topic of discussion was, well, I am the son or I am the daughter of some existing farmers, and I would like to take over the operation. How do I do it? And I deal with those situations day in, day out. I've met numerous families this week in southwest Queensland who are in succession planning, trying to work out how they can deal with it. I was with a family with 5 siblings the other day, one of which wants to be on the land and the other 4 don't, but the other 4 are interested in getting a degree of, some sort of share out of it. And we worked out, I think they're entitled on a pure split, $1.2 million each. We worked out that the couple that wanted to stay could probably raise finance of around $950,000, and we believe that's probably close enough to get the other family members to accept the succession plan in which this younger couple are able to move, to take over the operation. So succession planning is an obvious way for those already in the industry with your family to get in and sort of take over from there. The last point is joint ventures, partnerships, and equity partners. So they're quite complicated. People always ask, are there any sort of wealthy people that are ready to jump in? There are, but I have to say, and a lot of professionals will say there's generally a low probability of that happening. Next slide, please. Just let me know when that's come through.
You did.
Yeah, good to go, Brad.
Rightio. So I don't want to go on for too long because I know we've sort of got limited time. So you need to sort of, one of the great things you need to have is patience. Young people are always keen to get in and conquer the world sort of fairly soon. But the young people I deal with that are the most successful in reaching their ambition to get into agriculture, the ones that actually have a realistic time frame around getting in, and it could be starting with agistment and leasing, and they might be 3 to 5 year opportunities, which assuming things go well, create deposits for property. So have a strategic plan. Work out exactly what you want to do. Have an overall business strategy, which is how you will accomplish it. Have projected management plans and calendars. So give yourself time frames in which you want to achieve certain goals and be realistic about that. Do your projected cash flows around how you're going to achieve it and financially. Set achievable time frames, which I've just mentioned, and you need to consider all the aspects of getting into agriculture, which is the costs of purchasing a property. Stamp duty is quite expensive. I've just done a $4 million acquisition for some clients in the last week, and stamp duty was $220,000. Look at what infrastructure you require, machinery you require, what livestock. Typically, as a benchmark, for every dollar you spend on land, you can spend up to 30 cents on livestock. So build that into your, factor that in. And then you've got working capital, what you need to keep the property going, particularly in the first 12, 18, 36 months. Okay, next page, please.
You did.
Righto.
Yep, good. So when you're dealing with your bank, banks are always, generally always participating in your acquisition plans, whether it's bank plus vendor, bank plus family, bank plus your cash. Banks at the moment can be a low-cost form of obtaining capital. We're consistently getting around 4.5 to 5.25% for our clients, including the margins. And banks, there's about 12, 15 things banks need to see. The loan amounts you require, what type of loans, what terms you need. It's not about just saying, well, I just need $1 million. It's $1 million, first 3 years interest only, and then we can pay principal off of X dollars per annum. And I typically always do 3-year cash flows for any property acquisition, regardless of who I'm dealing with, because you need to show the bank not only your capacity to ultimately repay debt, but also how you're going to get there in terms of stock numbers and income. Your statement of position, your assets and liabilities. It may not look great at the moment, but over time, if you have a plan, a strategic plan and a business plan, you can build those assets and liabilities up. What security you've got to offer, a description of the security, what your equity is. Typically, a bank will look at a property acquisition of equity around 50%, which means of all the assets you have, your debt equals about 50% of all assets. That would be a minimum generally, as long as you have a goal to get up to about 65%. Your cash flow forecasts, and then your historical financial and production performance. There's no point doing a cash flow unless you can substantiate it, either through the historical financial performance of a property or the production performance of a property. Now, quite often I will underpin my cash flows with information that I obtained by the likes of DPI, in terms of gross margin, so that you have an independent third-party research underpinning your cash flows. Banks have their internal research as well. So it's critical that you get that right. You only get one chance with the banks. They're under-resourced. They're very busy. If you don't do it properly the first time round, they typically not real keen on re-looking at a deal just because of their time constraints within a 6 to 12 month period. So it's critical you get the timing right in the presentation. Last slide, please.
You did.
All right.
Okay, and above all else, it's very important that you team up with good business partners. Well, when I say business partners, people that can advise you, solicitors, accountants, again, your networks, your industry associations, your suppliers. What terms are you getting on the cattle crush that you're buying, or the sheep trench? Are you getting 30 days or 90 days, or what might it be? That all contributes towards your cash flow. So build those relationships. For instance, your wool and your sheep classes, all your contractors, shearing, etc. And of course, someone who's advising you on finance, and that can be 1 or 2 or 3 bank managers, or someone like myself that represents you in those negotiations. So surround yourself with the right people. Don't try and do this by yourself. I'm always happy to talk to people. And if we go to the last slide, please. Okay, you'll see my phone number down the bottom and my email address. I'm more than happy to discuss any scenarios you might have now or in the future. As I said, I in particular specialise in pastoral type finance. I have large-scale grain growers as well, but I've had 20 years experience in agricultural finance. I work with a lot of young people, as I do with older people, so I'm aware of all the opportunities that you have. I'm more than happy to help you manage some of those opportunities in terms of how you go about talking to vendors and how you structure the proposal, how you go about talking to banks, and a whole range of other people that might be able to help you achieve your objectives. So, I work 24/7. I have a wife that's off the land, is extremely supportive, so don't hesitate to call, night or day, 7 days a week. If there's anything you want to discuss, it won't cost you anything to run an idea or a scenario past me, and I've got a lot of experience and expertise in succession planning and family stuff, as I do with all those other bits that I've covered off on briefly tonight. So anyway, I'll finish up there. I'm mindful that